In this video, we will discuss economic crises, prevention, and risk management. This is an updated presentation that was originally given at Halt University as a master class on February 5th, 2013 in Dubai, the United Arab Emirates. My name is Kirby Arcundiff. I have a Ph.D., I'm a chartered financial analyst, and a certified financial planner. At the time of the original presentation, I was an associate professor of finance and chair of the Division of Business Administration at the Rochester Institute of Technology's Dubai campus. I'm currently the chair of accounting and financial management at the Graduate School of the University of Maryland, University College. Economic crises have been continuous throughout history. In this video, we will examine some of those that have occurred in the last 100 years in the United States. The most recent one would be the housing crisis that resulted in many bankruptcies of both individuals and banks and a stock market crash around 2007, 2008. Before that occurred the dot-com bubble, where the stock market dropped from 2000 to 2003, the Savings and Loan Fiasco of the late 1980s and early 2000s, inflation in the 1970s caused by the U.S. default on the gold standard from the Bretton Woods Agreement in 1971, the U.S. default on the gold standard in 1933 with the Great Depression, and the stock market crash that preceded that from 1929 to 1933. Before that, there was the Panic of 1907, which resulted in the creation of the Federal Reserve System. There were also comparatively minor panics during the 1800s in the United States. On this graph, you can see the number of bank failures as a function of year in the United States. You see three major peaks: the most recent bank failures associated with the housing crisis, the bank failures in the 1980s associated with the Savings and Loan Fiasco, and the bank failures in the 1930s associated with the Great Depression. Each of these sets of bank failures were related to monetary policy, but were caused by slightly different things. During the 1930s, the bank failures were associated with the boom-bust cycle in the stock market. Before the passage of Glass-Steagall, banks could take in deposits and not only make loans with them, but also invest in the stock market. This would result in the bank putting up maybe 10% equity of its own money, taking 90% deposits, investing it in the stock market. The bank made a lot of money during the 20s when the stock market went up. When the stock market went down, the banks went bankrupt. And of course, a little bit of a drop in the stock market resulted in a margin call, which resulted in more drops. This resulted later on in the Glass-Steagall rule, which split up banks into commercial banks that made loans, as opposed to investment banks which engaged in equity. For example, Morgan Guaranty, J.P. Morgan's company, was split into two different components: J.P. Morgan, which was a commercial bank, and what became Morgan Stanley, which was an investment bank. The bankruptcies of the Savings and Loan Fiasco were caused by something called duration mismatch, which resulted in the long-term loans of the bank being decreased in value drastically, while the short-term deposits stayed about the same value. This we will discuss more later in the video. Also, the housing crisis was the result of people who had gotten loans not being able to make the payments. These sort of crises also were generally associated with stock market booms and busts. You can see on this graph the huge drop of the stock market from its peak in 1929 to its trough in 1933. This is a graph of the Dow Jones Industrial Average throughout the 20th century and on into the early 21st century. Again, the stock market boom-bust cycle was associated with Federal Reserve activity. The U.S. was on the gold standard until 1913 when the Fed was created. When the Fed was created, it was supposed to back its currency with gold. It instead printed way more money than it had gold. Plus, during the 1920s, the Calvin Coolidge's administration drastically cut income tax from a high marginal rate of close to 90% down to around 10%. Both of these resulted in a major boom in the 20s. In the late 20s, the Federal Reserve stopped printing so much money to help out the British, since all the gold was flowing from Britain to the United States. This started the stock market crash. And then during the Great Depression, Roosevelt increased taxes again up to the 90% marginal rate, which caused the Great Depression to continue until beyond World War II. The excuse for creating the Fed was this relatively minor panic you see around 1907. Panics had occurred throughout the 1800s, but they were relatively mild compared to what we've had since the creation of the Fed. Things like, again, the Great Depression, the dot-com bubble, and the two banking crises. This is a log graph, which makes the early time periods look larger than later time periods. So as we go later in here, this is a 40% drop. This is a consolidation period with 40% drops. After World War II, the U.S. was again on the gold standard, something called the Bretton Woods Agreement, but it was only an international gold standard. Roosevelt had defaulted on the gold standard in 1933 domestically. The international gold standard only applied to central banks. So one central bank, if it had too many dollars, could take them and exchange them at the New York Fed for gold. The way this system worked is all of the world's major currencies were tied to the US dollar. The US dollar was tied to gold at $35 per ounce. In the late 1970s, the French and other countries realized that the US Federal Reserve System had again printed more money than it had gold to back it, and the French started demanding gold. As the French brought in dollars, in the basement of the New York Fed, there is a series of jail cells, and each jail cell is gold associated with a given country. So the French would bring in dollars, and gold would be removed from the US jail cell to the French jail cell. The French did this multiple times. The British tried to bail out the United States. Finally, the US defaulted, and Nixon took the US off the gold standard. This ended in the early 1970s, where you can see this major stock market boom from World War II to the 1970s also ended. After that, there were major inflation problems. The Fed tried to raise interest rates, cut down on inflation, resulting in multiple 40% drops in the stock market. This was finally stabilized by the appointment in 1979 of Paul Volcker by Jimmy Carter to the Fed, who massively increased inflation rates, put the U.S. into recession, but stabilized the currency. We then had a run-up in the greatest bull market in U.S. history from '82 until 2000, which you can also see on the graph, followed by drops in the stock market associated with the dot-com bubble and with the housing crisis. Does government policy cause or prevent economic crises? The discussion in most of this presentation is associated with the Austrian theory of economics, or the Austrian business cycle theory, developed by Ludwig von Mises and Friedrich Hayek. Friedrich Hayek got the Nobel Prize for this. The Keynesians, on the other hand, believe that all of these movements back and forth by the Fed, printing money, retracting the money supply, help mitigate economic crises. Monetarists are more associated with the printing of money, again mitigating economic crises, but they don't pay very much attention to what causes them in the first place. For example, the Austrian economists will talk a lot about the government printing money in the 20s, causing the stock market bubble. The monetarist will talk about the time period during the 30s, the Great Contraction, as written by Anna Shorts and Milton Friedman, and how the government should have printed more money at that time period. This is a graph of the general price level from 1800 until 2000. So the derivative, or slope of this, is the inflation rate. The Fed was again created in 1913, and you can see before the Fed was created, there was very little inflation. There were a few bumps, the War of 1812, the Civil War, and then continual increases pretty much after the creation of the Fed. When the U.S. was first founded, there was a debate between Thomas Jefferson and Alexander Hamilton about whether a central bank should exist. Alexander Hamilton wanted one, Thomas Jefferson did not. George Washington backed Alexander Hamilton, and the first Bank of the United States was created. You can still tour the building in Philadelphia. Thomas Jefferson was not able to get rid of this bank. Its charter did not come up when he was president, but it did come up when one of his proteges, James Madison, was president. Madison initially let the charter retire, but then during the War of 1812, when the White House was burned, he came to the conclusion that a central bank might be useful for financing wars to fight the British. He therefore created the Second Bank of the United States, which building is also in Philadelphia. This created this first bump you see here for the War of 1812. The charter for the Second Bank of the United States came up during the presidency of Andrew Jackson. Andrew Jackson was opposed to the bank. Nicholas Biddle, who was the head of the bank at that point in time, said if Jackson got rid of the bank, he would try and destroy the economy to get Jackson no longer not reelected as president. Biddle attempted to do that. Jackson got rid of the bank. People did not, in fact, believe Biddle. And we had no central bank from the presidency of Andrew Jackson until the creation of the Fed in 1913. We did, on the other hand, have Abraham Lincoln printing greenbacks during the Civil War. He also created the first income tax, which was declared unconstitutional after the Civil War. The printing of greenbacks resulted in this second bump. So you can see under the gold standard, there was very little inflation. This made it relatively easy to do business, predict the future. You knew what prices would be 30 years in the future. But of course, inflation favors debtors. One of the reasons we have so much money printing now was the biggest debtor in the world is the U.S. government. Debtors at this point in time would have been farmers. Farmers, therefore, found it appealing when William Jennings Bryan made his Cross of Gold speech. The Cross of Gold speech was for advocating a bimetal standard, not just gold, but also silver, the purpose of which was to create inflation, to devalue the debt of the farmers. Again, there was a minor panic in 1907. J.P. Morgan was associated with bailing out the stock market and, to a lesser extent, the government during this time period. This was used as an excuse to create the Federal Reserve System, which, from the Austrian perspective and my perspective, made everything far worse. Again, the Fed printed tons of money, resulting in the stock market boom in the 1920s. Some of the boom was real, some of it was inflationary. Again, Treasury Secretary Mellon and Calvin Coolidge also drastically cut income taxes during that time period, which is discussed on another one of my videos on history of income taxes. After the crash of 1929 to 1933, Roosevelt defaulted on the domestic gold standard, and money was pretty much printed continuously until today. And you can see the US dollar has been drastically devalued as this graph continues on out. The US dollar is worth basically less than 1% of what it was when the Fed was created. This is Roosevelt's executive order making gold ownership illegal in the United States. Roosevelt made it illegal for individuals to own more than 5 ounces of gold and also seized all of the gold from all of the major banks. This is the reason that Fort Knox was built and all the gold was put in it and guarded at the bullion depository. This then freed the government to print as much money as it wanted to without any gold backing, which has resulted in significant destabilization of the stock market and the economy since 1933. The U.S. is, of course, not the only country to experience these problems. As of yet, the U.S. economy, while it has had lots of instability, these instabilities have been minor compared to other countries. For example, the Weimar Republic in the 1920s that gave rise to Adolf Hitler. Just as the US is now printing money, the Weimar Republic printed tons of money to finance its own social programs, socialized medicine, and to pay reparations to other countries. They devalued their currency so much that this woman is burning currency for heat because it is cheaper than firewood. Obviously, under this kind of instability, it is relatively easy for democracy to fall and a dictator to take power. That dictator was Adolf Hitler. He did stabilize the currency and, to some extent, improve Germany's economy, and then, of course, created wars, mass chaos, and mass murder. The Federal Reserve's ideas of monetary policy have changed over the years. During the Great Depression, they had, in some sense, the opposite policy of what they had today. During the Great Depression, as the economy contracted, the Fed let the money supply contract. Keynesians would say this made the Great Depression worse, and it may very well have done so. Today, they try and sort of do counter-cyclical policy and expand the money supply if the economy contracts, but they don't seem to do it in a very stable manner. Since 1935, this shows a graph of the Fed funds overnight lending rate, and you can see it has been very volatile, making it very difficult to do long-term business. The rate goes up, the rate goes down, the rate goes up, the rate goes down. After the default in the 1970s of the gold standard, you can see the Fed attempted to cut down on inflation by first increasing interest rates, then lowering them during the default of the gold standard, then increasing interest rates, then lowering, then increasing interest rates, then lowering them. This final move up here finally did somewhat stabilize inflation under Paul Volcker, and then the drop from this time period down to 2000 was associated with the biggest stock market bull in U.S. history. There were, of course, time periods that this created more problems. This resulted in the Savings and Loan Fiasco, as we will discuss later. This little bump up in here, the rundown, of course, resulted in a stock market bull, perhaps irrational exuberance in a stock market bubble, and then the raise in interest rates here was associated with the bust of the dot-com bubble. Then, as you can see again, from 2000 to 2004, interest rates were lowered drastically. Whenever you print money, and the way this works is when you lower interest rates, you do it by the government printing money and buying U.S. Treasury bills. That creates inflation. It has to go somewhere. From 82 to 2000, it went into the stock market, particularly at the end tech stocks. During the next cycle, it went into people borrowing very short-term interest rate loans and buying houses. The movement then up in the Fed funds rate from around 2005 to 2007 then burst the housing bubble, and after that, the Fed again lowered interest rates now down to zero, where they stayed for many years, and they're just starting to slightly increase. Details of the further policies of the Fed, including quantitative easing during this time period, are also discussed in another video on the history of the stock market. Well, most of the price controls that Nixon created in the early 1970s were soon repealed. The one exception was price controls on crude oil. This continued until the Reagan administration. And you can see during that time period, from the early 70s until the early 80s, there are two different lines on this graph. The graph represents the price of a barrel of crude oil from around 47 to 2012. And during the 70s, there is both a lower red line and an upper black line. Since U.S. price controls put the price of oil domestically at well below the world price, Texas and Oklahoma oil producers were not very happy. They were not able to sell their oil at the higher world price. Further, world producers of oil like Saudi Arabia and the other OPEC countries were not very interested in selling to the United States since they could not get a competitive price for oil. This resulted in oil shortages in the United States, particularly in the late 70s during the Carter administration. It was not uncommon to go to a gas station and the gas station would be out of gas. This was spun as the world was running out of oil. That wasn't really the case. Only the U.S. was running out of oil. Reagan repealed these price controls and legalized futures trading in oil on the Chicago Mercantile Exchange. This graph shows yield curves at three different time periods, 1999, 2000, and 1980. The lower two graphs are so-called normal yield curves, which means that short-term interest rates are lower than long-term interest rates. This is called normal because if you make a loan, you're generally more worried about making a long-term loan than a short-term loan. It also shows how banks and savings and loans commonly make money. They borrow short-term and lend long-term. Since the long-term rates are higher than the short-term rates, they tend to make money. This was not the case in 1980, where short-term interest rates were pushed up by Paul Volcker at the Fed and long-term interest rates remained low. The long-term rates were low because people actually believed Volcker would get inflation under control, and they could therefore make money by buying long-term government bonds at 12% interest. This turned out to be a very good strategy. You would be able to get 12% risk-free from 1980 until 2010, whereas the stock market, which makes on average about the same thing, was far more volatile. This also shows further how bankruptcies in the savings and loans were created, since the savings and loans would have to borrow at a higher short-term interest rate than they lent at. And as we mentioned, Regulation Q actually made this illegal. So individuals would remove their money from savings and loans, and then they would stick them into the new creation, the money market fund. U.S. government debt, which this is a yield curve of, could only be invested in with reasonably large denominations of cash. A treasury bill might be $10,000. So if you had less than $10,000 to invest, you would have to stick it in a bank under Regulation Q at only a little over 5%. If you had over $10,000, you could make $15,000 in government debt. Money market funds allowed people to pool their money, and that pooled money then allowed poorer people to get a higher interest rate. Initially, the government declared this illegal, but they backed down. Then disintermediation continued. People pulled all their money out of banks and savings and loans and put their money into money market funds. The way you value a bond or a home mortgage is a discounted sum of cash flows. So the P here would be the price of the home mortgage. It's a discounted sum of all future payments. This shows further the difference between the housing crisis and the savings and loan fiasco. The savings and loan fiasco was caused by the I here, the interest rate at the bottom, increasing, therefore decreasing the value of the home mortgages to below the equity of the bank. This doesn't mean people weren't making the payments on their loans during the savings and loan fiasco. They were. It's just that the value of those payments to the bank was so low, they could no longer pay the passbook account interest. The housing crisis, on the other hand, was caused by people not being able to make the payments, the C in the top of this equation. So in both cases, the banks went bankrupt, but the cause was two different things. This is a further demonstration of what would cause the housing crisis. When the Fed had interest rates very low, say 1%, a person could buy a $500,000 house, and the monthly interest payment on that would only be around $417. Relatively easy for many people to make. But the Federal Reserve then proceeded to increase interest rates, let's say to 5%. Then the payment on the same house, if you had an adjustable rate mortgage, might go to over $2,000. Many families that could afford the $400 monthly mortgage could not afford the $2,000 monthly mortgage. They would then default on their home payments. The bank would then lose money. Both the individuals would go bankrupt, and in many cases, the bank would go bankrupt. And this resulted in a $1 trillion bank bailout. The savings and loan fiasco also had resulted in a government bailout of the banks in the range of several $100 million. Well, the U.S. has had unstable money and many economic crises they have actually been relatively mild compared to what has occurred in many other countries in the world. This shows the inflation rate in Russia in the early 90s being around 800%. Under these conditions, it is extremely difficult to do business. If you get a paycheck, you pretty much have to spend it immediately or it loses all of its value. If you're running a store, you have to constantly raise prices. It's very difficult to do business. Venezuela currently is having this sort of an economic crisis. This shows the graph of their inflation rate around 2015 when it exceeds 800%. Later it gets even higher. And again, it's extremely difficult to do business in this environment. People are attempting to flee Venezuela. There are samples of people doing business like buying a cup of coffee in South America during this time period and previous high inflation time periods, and the price of the cup of coffee may go up while you are drinking it. The recent best example of the destruction of inflation is in the country of Zimbabwe, where inflation exceeded a number I'm not even going to try and pronounce here. At that point in time, the Zimbabwe currency was basically retired. Nobody would accept it anymore, and Zimbabwe went to the US dollar. The last Zimbabwe currency issued was the $100 trillion note. This is now worth more on eBay as a collector's item than it was in Zimbabwe. Obviously, this resulted in economic chaos in Zimbabwe. At the same time, Zimbabwe was seizing farms and making it illegal for white people to own property, most of which fled the country. A comparable situation, although not nearly as bad, is starting to occur in South Africa. The U.S. has problems with inflation, but not nearly to the point of Zimbabwe. They are attempting in the U.S. to paper over and hide what's going on. One of the ways they do that is by redefining the inflation rate. They've redefined how you calculate inflation multiple times from the 1980s. The U.S. government's incentives for doing this are to cut down on the amount of money they have to pay for Social Security. If you use the real inflation rate, the Social Security checks would be larger. That would cost the government more money. It's also a stealth way of raising taxes. If you used a real inflation rate, then every year the tax brackets would go up and therefore people's percent payment in taxes would go down. This graph shows an example in the 2000s by Shadow Stats of what the inflation rate would be, let's say in 2018. If you use the 1990 mechanism of calculating inflation, it would be around 6%. If you use the current rate way of calculating inflation, it's around 2%. The kind of changes the government made are, rather than using a static basket of goods, they used a dynamic basket of goods. The assumption would be if steak prices go up, you switch to chicken, but this doesn't lower your standard of living any, so the increase in steak prices doesn't actually create inflation. They also included what are called hedonic corrections. If the price of an item went up this year and it's a slightly different item, then there is no inflation rate because the item has been changed. It's a nicer car or a nicer computer. How do we cure these problems? Well, one of them would be to require banks to actually have equity. Under international agreements called the Basel Accords, banks have to comply with Tier 1 and Tier 2 capital requirements. The details of this are discussed in one of my papers with the Foundation for Economic Education on why do banks keep going bankrupt. The Tier 1 and Tier 2 capital requirements, our Tier 1 capital ratio is Tier 1 capital over risk-adjusted assets. Total capital is Tier 1 plus Tier 2 over total capital equals total capital over risk-adjusted assets. The key of this is how low these ratios have to be. Supposedly, a well-capitalized bank under federal bank regulations means the bank must only have Tier 1 capital of 6% and total capital of 10%. Basically, they can engage in 90% plus leverage. Most businesses cannot do this. It makes banks very unstable. It makes it easy for them to go bankrupt. And of course, if the bank makes money, the bank keeps the profits. If the bank loses money, the taxpayers have to bail them out, either through FDIC insurance or more extensive bailouts like occurred during the housing crisis. This is what's called a moral hazard problem. The incentive for the bank is to take on a lot of risk. If things work out, the bankers are happy. They get very high salaries. If you have problems, well, that's the taxpayer's problem. So how do we prevent or at least mitigate economic crises? More stable monetary policy. Stop printing so much money. The easiest way to do this would be to go back to the gold standard. There were relatively few or relatively minor economic crises during the 1800s when people used gold in the US for money. If you're not going to do that, you could at least increase the required equity under the Basel Accords for banks to something like 20 or 30%, decreasing leverage drastically. Since this talk was first given in the Middle East, one of their solutions to it is Islamic finance. Under Islamic finance, there are not supposed to actually be loans, not debt instruments, but instead banks are supposed to operate like investment banks, where the bank takes an equity position. In reality, most banks that claim they're Islamic banks really are not, and rather than having usury and calling something a loan, they tend to call it profit, but they operate in largely the same way as Western banks. How can smaller countries mitigate these problems? Should they tie their currency to the dollar or the euro or not? Different countries have used different strategies. There are certainly countries like Switzerland who have done very well independently, keeping a very stable currency, even though they are small, whereas the Persian Gulf countries and countries like Estonia have tied their currency to a bigger currency. The Persian Gulf countries have kept their own currency but have pegged it to the US dollar, whereas Estonia has converted its currency to the euro. I would probably advise to do what the Persian Gulf countries did instead, peg it to a bigger currency, but then if that currency gets into trouble, you can always unpeg. Estonia would have a lot of difficulties de-euroizing. Norway, like Switzerland, has kept its own currency. It's a lot easier for them to do things like this since they have vast oil reserves. As an individual, how do you protect yourself from economic crises? Well, the best thing is to diversify, have not only stocks, but real estate commodities. I would probably avoid long-term bonds since you are guaranteed to lose money with bonds since you will have inflation. Also keep your debt levels low. Use equity when you can. Maybe take a home loan, but certainly do not take a car loan or a credit card loan. And also diversify not only domestically, but internationally. As discussed in other videos, my favorite investment fund is Vanguard funds. They use index funds. The best one domestically is the Wilshire 5000 VITSX, and they also have lots of international funds. For further reading, I recommend several articles with the Foundation for Economic Education. They have several of my articles on monetary policy and bank failures. There are also similar articles with the American Institute for Economic Research, and the graph from oil price history came from this organization, which is a company in Arkansas dedicated to studying oil prices. I thank you for watching this video.